Good evening, ladies and gentlemen. Thank you to Suresh Goyal. Thank you to NCAER. Thank you to ICAP. But I think most of all, thank you to the audience for turning out on a Friday night for a technical uh, lecture on economics and politics. It's an impressive demonstration of the appetite, I think, for uh, information and analysis about these issues. So you will infer from the title what the subtext of this talk is. Um, it starts with the observation that the U.S. dollar is the currency of the United States, but also of the world, that trade amongst countries that never touches U.S. shores is disproportionately invoiced and settled in dollars. The dollar is the dominant currency in international banking. The dollar is on one side of fully 90% of foreign exchange trades worldwide. More than half the foreign exchange reserves of central banks around the world are in US dollar securities and deposits. Uh, why the dollar plays this disproportionately important role is no mystery, I think. The dollar's dominance reflects the fact that the U.S. has been the single largest economy in the world now for almost a century and a half. Since 1870, the U.S. Was, since 1913, the largest exporter in the world, recently overtaken with China. The market in U.S. Treasury securities is the single largest and most liquid financial market. And the dollar's dominance, if you will, feeds on itself. The fact that so many other importers, exporters, international investors around the world make payments in, do cross-border transactions in dollars, makes it attractive for others to do likewise. So that network effect, to give it its technical phrase, lends persistence to uh, the dollar's centrality in the global monetary and financial system. I would argue that this is, on balance, a happy situation from the point of view of the United States. It confers advantages on U.S. banks and firms that are able to do international business in their own native currency. It has historically allowed the U.S. government to borrow at lower interest rates than would be available to it otherwise, because there is this large additional demand for U.S. Treasury securities out there in the rest of the world. The U.S. has enjoyed automatic financial insurance as a result of the dollar's safe haven status. So when there is a spike in global volatility, when a bad thing happens in the global financial system, funds rush into dollars rather than out. The U.S. doesn't suffer from capital flight, quite the opposite. And that's true even when the U.S. is responsible for the bad thing. Think the collapse of Lehman Brothers in 2008. And finally, U.S. financial sanctions bite more than they would otherwise as a result of the centrality of the dollar and the U.S. correspondent banking system in global monetary and financial affairs. What is, on balance, a happy situation from the point of view of the United States is not viewed entirely in the same way by other countries. So if you can recall 1971, when Richard Nixon pulled the plug on the Bretton Woods system, closed the gold window, suspended the commitment of the United States to convert dollars into gold for official foreign holders at a fixed price of $35 an ounce, foreign finance ministers complained about U.S. unilateralism to Nixon's Treasury Secretary, John Connally, and Connally, with typical Texas bravado, responded, "Look, guys, it's our currency, but your problem. You have no choice but to live with it because there is no alternative to the greenback on the international stage. So what is different today is the existence of potential alternatives. The euro and the Chinese RMB are widely cited as potential alternatives, and there are also efforts underway to construct dedicated digital platforms under which central bank digital currencies and tokenized commercial bank deposits can be moved across borders, can be exchanged for one another without having to go through the dollar and the U.S. correspondent banking system. Um, Actual and potential, actual and hypothetical alternatives are not the same. There are obstacles to more widespread use of the euro and the Chinese RMB, and I will talk about those in a few minutes, while the technological obstacle to creating a single blockchain or a dedicated digital platform on which central bank digital currencies can be exchanged for one another. Although that technical problem has been solved, I think the political problem of how to govern and regulate those kind of platforms has not been solved, and that creates a formidable obstacle to scaling up those kind of initiatives. Um, there is, in fact, a much longer history of global currencies. You might ask, having written those other books that were flashed on the screen a few minutes ago, why have I returned to this topic? And it was in order to explore that longer history. So it was a treat for me to read the literature on archaeology. If you're going to think about the cross-border use of ancient uh, Athenian and Roman coins, you end up looking at archaeological evidence. You end up looking at the evidence from uh, numismatics. And that is in part what I exploit in this book in an effort to draw out the implications for today and for tomorrow. So that, as I said, that longer history goes back to the owls, the symbol, the emblem of ancient Athens, and the Alexanders, which circulated around the Aegean, but more widely around the Mediterranean and into the Near East for centuries. The Roman coins of Julius Caesar and subsequent Roman emperors. So Caesar famously carried with him a portable mint when he crossed the Rubicon with his troops in order to pay them in silver coin and maintain their loyalty. Roman coins circulated everywhere from Scotland in the northwest of Europe into Persia, modern day Afghanistan, India, of course. China, they have been found in Japan, although when they got to Japan, when and how is something of a matter of dispute. The solidus of the Byzantine Empire circulated in the Near East, again, into Asia, into Persia, Afghanistan. Hoards have been found in India as well. The florin of the city-state of Florence was probably the leading currency that circulated throughout Europe in the 14th and 15th centuries. It was unique and important because its international status was based on finance rather than trade. So Florence was not a major trading power as a city-state. It didn't have a lot of natural resources. It didn't have a powerful military. But what it had was influential and innovative banking families, the Medici and the Bardi and others, who set up what were essentially the first multinational banks branched all over Europe, able to move credit denominated in florin across space without having to transport actual specie, precious metal, without having to hire large men with guns or spears in order to protect that metal when it was transferred. Spanish silver coin, the famous pieces of eight chopped up into eight pizza-shaped slices to make small change, were really the first global currency because of the large amount of silver discovered and exploited by the Spanish in the New World, because the Spanish crown understood the value of seigniorage, and they maintained the stability of the currency, the purity and weight of their coins for 3 centuries, basically. So Spanish silver was exported to Spain. It was smuggled to other parts of Europe. It reached Asia and China via the famous uh, Manila galleons that sailed from Acapulco to Manila and on to China. So this was really a true global currency. It remained um, the dominant form of coined money for large value transactions in China into the 19th century. These coins, minted in modern day Peru and Mexico, were legal tender in my country, in the United States, until 1857, after we discovered gold in California and then silver in Nevada and had sufficient specie to mint our own coins at scale. Um, the Dutch guilder was the leading international currency in Europe and beyond in the um, 17th and 18th centuries. And it was important because it was essentially a fiat currency. It took the form not only of coin, but also of bills of exchange, claims on the Bank of Amsterdam, the proto central bank, that after a point in time were not redeemable in precious metal. They were uh, um, accepted in payment throughout Europe and beyond because of the creditworthiness of the Bank of Amsterdam and of the shareholders in the bank that valued the stability of the coinage. And you will, of course, know from uh, India's experience that the pound sterling was the leading international currency in the 19th century when Britannia ruled the waves and into the 20th. So um, it feels a little peculiar to try to summarize a 300-page book in 30 minutes, my task for the evening, but I think some um, general conclusions do um, follow from this history. First, that international currency status has important economic and financial foundations. It rests on the strength of the economy of the issuing state or kingdom. It rests on the commercial and financial on the extensive nature of the commercial and financial links of that economy with the rest of the world, how much it imports and exports, how much it lends and borrows across borders. It rests on the depth and liquidity of that country's financial markets, and it generally rests on the presence of an institution, a central bank, or kindred institution to backstop those markets, to act as a liquidity and liquidity provider and lender of last resort. You'll infer that there's a subtext here about the prospects for the dollar if separation of powers, rule of law, control of corruption are important for the stability of and confidence in the currency. There are newfound questions about those, the strength of those institutions in the United States. And there are important international political preconditions as well, that uh, central banks and governments prefer to hold and use the currencies of their alliance partners. The strength, confidence in the durability of those alliances is important for uh, the um, maintenance of a currency's centrality in the inter, international monetary and financial system. So again, you can infer the subtext here about whether questions about America's commitments to NATO and its other alliance partners may have implications for the dollar going forward. Um, I would argue that the dominance of the dollar has been eroding modestly on various margins. So here on the right, you can see what has happened to the dollar's share of uh, foreign exchange reserves of central banks around the world over the course of the 21st century. That share has gone down by about 0.5 percentage point a year on average, year after year, from a bit more than 72% of the global total at the turn of the century to a bit less than 60% of the global total today. The share of U.S. Treasury securities held abroad by official and private foreign investors combined has been going down slowly but steadily over the course of the last century. And the yield advantage that the U.S. Treasury has enjoyed when borrowing on global financial markets has, recent research shows, essentially disappeared. Um, I would argue as a result of questions about debt sustainability in the United States, but also questions about the strength of domestic political institutions and U.S. alliances. So, to reiterate, I would attribute these trends to questions about debt sustainability, that debt as a share of GDP in the United States is back up to its post-World War II level, and on uh, current law, on current trends projected to uh, rise explosively going forward, and high levels of political polarization really prevent the U.S. political system from addressing the concern. There are questions about financial stability in the United States. We saw them pop up in 2023 with near-death experience of Silicon Valley Bank. I think about the financial pendulum after the global financial crisis. It swung strongly in the direction of tighter financial regulation. But as memories of that crisis fade, it's beginning to swing back in the other direction as the Fed cuts back on its supervisory staffing, as it lightens its periodic stress tests of the banks, as it reduces the uh, uh, limits on leverage for the largest banks, and as financial risks pop up in other parts of the U.S. financial system, private equity, private credit, and so forth. Um, Questions about the independence of the Fed, threats to the Fed's independence, have not gone away despite the installation of a new Federal Reserve chair. So President Trump's threat to one of the sitting uh, uh, governors on the Federal Reserve Board, Lisa Cook, have been renewed in recent weeks and months. And I think even more serious than that are proposals out there from Scott Bessent, Treasury Secretary Scott Bessent, and others to change the way the regional Reserve Bank presidents are appointed, and to give the Treasury and the White House more of a say about how they're selected. There are questions about the swap lines that the Fed has traditionally extended to foreign central banks. So one reason foreign central banks are relaxed about seeing their local banks and firms borrow dollars and use dollars in their cross-border transactions is that those foreign central banks can act as dollar lenders of last resort, courtesy of the swap lines through which the Fed provides them with dollar credit. Will a Federal Reserve Board concerned to shrink the Fed's balance sheet continue to extend these swap lines? Will isolationist Federal Reserve Board governors appointed by an isolationist president continue to extend these swap lines? I think there are real questions about that. And when I talk to central bank, the governors and others of central banks that have been on the receiving end of these swap lines, they are concerned about whether their provision will be maintained. I said before that important international currencies have historically been the currencies of trading powers. Will the United States continue to be a large importer and exporter, or turn in an even more protectionist direction going forward? President Trump's tariffs have raised obvious questions about this. And the U.S. has taken increasing recourse to financial sanctions. So again, uh, that has uh, encouraged policymakers around the world to think about hedging dollar risk, to diversify at least on the margin away from the dollar. So in the event that their access to dollar credit in the U.S. financial system is curtailed, they have alternatives available to them. I actually think that weakening U.S. alliances are the single most important factor here. As I said before, America's alliance partners have historically relied heavily on the dollar and played an important role in supporting the dollar when it has come under strain. So when the dollar's fixed link to gold came under strain in the 1960s, it was the governments of West Germany and Japan, which relied on the United States for security, for their nuclear umbrella, where in both countries, we had troops on the ground. They were the countries that intervened to support the dollar in that period. Um, People talk about the petrodollar. I view the petrodollar as emanating from a bargain between the United States and Saudi Arabia in 1974, when first Treasury Secretary William Simon and then Henry Kissinger went to Saudi Arabia and basically said, we will continue to provide you security in your insecure part of the world if you recycle your oil earnings in the form of dollar deposits in London and New York, and that bargain has persisted pretty much down to the present day. Will it persist in a world where questions arise about America's commitment to its alliances? So, if for all the aforementioned reasons dollar dominance diminishes, who or what will benefit? Here is my complete list of candidates. There is supposed to be a question mark after each of them because of the high uncertainty about who the beneficiary will be. My view is that all of these alternatives will probably gain a bit of ground on the margin as countries hedge their dollar risk, but none of them has the scale and the attributes needed to substitute for the dollar at scale. So you will know that central banks have been benefiting from higher gold prices where they hold gold, and that emerging market central banks have been accumulating gold since the global financial crisis, where the Reserve Bank of India has revealed that it is among those central banks. And in a world where there are limited diversification benefits, diversifying into gold is one option. It has the weight of history. Uh, it is a respectable thing for central banks to hold. It provides those diversification benefits. It can be traded in a relatively liquid market in London. It can be used in financial transactions. It can be lent or used as collateral if it's vaulted in London or New York. It's safe from being garnished from sanctions if you vault it at home, but it has disadvantages as well. The price is volatile. It's awkward for use in actual payments. It cannot be lent or pledged if vaulted at home, and it doesn't bear interest, unlike securities and deposits. Um, the euro. The euro has gained zero ground as an international currency since its creation in 1999. So one of my friends and co-authors at the European Central Bank is responsible for the annual report on the international role of the euro, and this composite indicator of the euro's international role, and I like to rib him that this looks a bit like the electrocardiogram of a dead person, that there isn't much movement here. There were doubts about the survival of the euro until Mario Draghi made his "we will do whatever it takes" speech in 2013. There is a shortage of AAA rated government paper in the euro area, maybe only a tenth as much as there is U.S. Treasury securities in the hands of the public. Markets in those safe assets are siloed, they're illiquid. German banks hold German bonds to meet their capital requirements. Dutch insurance companies hold Dutch bonds to match their liabilities. Capital Markets Union, the project designed to break down those silos, hasn't gained much ground, and Europe doesn't have a common defense and foreign policy to accompany its money. The Chinese renminbi is the currency of the leading trading nation. Depending on how you measure things, the second largest economy in the world, but it barely shows up in international financial markets, where the dollar still accounts for 57% of global foreign exchange reserves, the euro accounts for 2%, and so forth and so on. For the simple reason that the RMB is starting out way behind the dollar. The U.S. has been actively internationalizing the dollar for more than a century. China has been moving down this road for maybe a decade. The U.S. has been building modern financial markets for 250 years. China has been doing it for 25 years. So even if the cross-border transactions denominated in renminbi continue to grow at double-digit rates, it will take decades for the renminbi to come within hailing distance of the dollar. And I have my doubts that anything in China, given the demographic headwinds, will continue to grow at double-digit rates. Non-traditional reserve currencies actually are a not often noticed but important factor in the evolution of the international monetary and financial system. 3/4 of the ground that the dollar has lost as a reserve currency in the last 25 years has been gained by these non-traditional reserve currencies, the currencies of small, open, well-managed, generally inflation-targeting countries: Canadian dollar, Australian dollar, New Zealand dollar, South Korean won, the Nordics, and so forth. And the reason for that is these currencies have become easier to buy, sell, hold, trade, given the rise of electronic trading platforms. So the bid-ask spreads on the non-traditional reserve currencies in red here have basically converged to the bid-ask spreads on the majors, shown here in blue. Market cap is too small for them to make a significant dent globally, but they provide some diversification opportunities on the margin. Adding the rupee to this list, there have been some efforts with local currency settlement. As you know, the ones I'm familiar with have focused on Russia, the UAE, Bangladesh. The RBI has made some efforts through Vostro accounts to encourage these settlements. But as I read the evidence, local currency settlement in rupee really hasn't gotten off the ground. Capital controls have something to do with that. But the simple fact that Russia doesn't have a particular interest in accumulating rupee. It doesn't buy a lot of other stuff from India. India doesn't have a big interest in accumulating rubles. Local currency settlement bilaterally is likely to work if you have bilateral trade balance, and we don't live in a world of bilateral trade balance, no matter how much Donald Trump would like us to. Finally, what about a network of central bank digital currencies? We have such a network, Project Mbridge, which was a project led by the Bank for International Settlements until pressure from the United States in 2024 led the BIS to step out. This is really a China-led project now. The code for this blockchain-like platform was written in the Digital Institute of the People's Bank of China. The validation protocol was written in the Digital Institute of the PBOC. The platform works. $55 billion of cumulative transactions have been cleared using tokenized central bank money using this platform. So for most of us, maybe not for all the asset managers in the audience, but for most of us, $55 billion sounds like a big number, but it's small potatoes compared to the volume of transactions cleared daily through the U.S. correspondent banking system and so forth. Still, I see no reason why this platform can't be ramped up. No technical reason. The obstacle, as I said before, is political rather than technical. Currently, there are 5 participants in using Project Mbridge, and they make decisions about how to regulate it, who can join, and so forth by consensus. They sit around a table and they discuss until they agree or they're exhausted. That works for 5 central banks, but it wouldn't work for 105. At that point, before they reach that point, they would need a voting rule to make those regulatory and membership decisions. Would it be one central bank, one vote, as in the United Nations General Assembly? Or would it be weighted voting by country size, as in the International Monetary Fund? I submit that China would insist on weighted voting by country size, which suggests that this platform might work at the regional level or might work more precisely for a collection of countries that were geopolitically aligned with China. But this kind of platform would be hard to generalize to the global level. There is an alternative to this China-led system on the drawing board, Project Agora, which involves the usual Western suspects, but also the Bank of Mexico, the Bank of Japan, and the Bank of Korea. It does not involve the Reserve Bank of India, to my knowledge, and maybe that's something that the RBI should be thinking about as a way of being able to do transactions with Asian countries, transactions with the West, both without having to go through the dollar and the U.S. banking system. I should emphasize that Project Agora is still just a prototype. It hasn't been used for actual transactions, but it seems to be a workable prototype. Finally, there's the possibility that if confidence in the dollar is lost, central banks and others will dump dollars in favor of alternatives that are less liquid, that can be used less widely, either both less liquid currencies and other assets, gold or whatever, that are awkward for payments. That's a world where central banks will have less firepower with which to intervene in foreign exchange and other markets. That's a world in which corporates and banks will find it more costly to source credit needed for international transactions. So when I teach the Great Depression of the 1930s, I show this famous League of Nations spiderweb diagram that shows the progressive collapse of international trade. Part of the story underlying that diagram was the Smoot-Hawley tariff and retaliation. But another important part of the story underlying that diagram was the collapse of confidence in the reserve currencies, the pound sterling and the dollar. In the 1930s, the liquidation of foreign exchange reserves, increases in the cost of sourcing trade credit, as exchange rates began to move around chaotically, the imposition of exchange controls, and you got the downward spiral of international trade and international investment. So to conclude, this suggests to me the possibility of two scenarios going forward. The first one, in which dollar dominance continues to erode very gradually. The constraints that up until now have prevented the euro, the renminbi, non-traditional reserve currencies from playing a larger global role are gradually relaxed, and the international monetary and financial system has time to evolve uh, away from its current dollar-centric structure in a more multipolar, decentralized, diverse direction, versus a second scenario in which confidence in the dollar is lost abruptly, um, causing private and official holders to flee before the alternatives have had time to develop. The result in that case being a global liquidity shortage like that of the 1930s, where globalization, as we know it, is placed at risk. So to conclude, let's hope for the first scenario. Thank you very much.